What's going on, option investors? My name's Henry, and if you're new, I'm continuing a series on options because that's my area of expertise when I was working at Goldman Sachs. And in this video, I'm going to explain an automated option trading strategy that I use to bring in consistent weekly profits. This is by far the best strategy I've ever used, and I've taught thousands of my coaching students on. I've got a lot of these positions currently open, and I'm gonna show you later in this video my portfolio. So make sure you stick around because I'm gonna show you how to take advantage of the best strategy that I have to offer. The wheel is something that is not talked about enough, and basically all you really need to know to do this strategy is how to sell cash covered puts and how to sell covered calls. I have both of those videos in my playlist, and I'll drop specific links for you guys in case you need to watch those videos before you run the wheel strategy for yourself. What I absolutely love about the wheel is it creates an optimal way for an investor to make income from options while also getting great entry into stocks for cheaper than they're currently traded at in the market. And you can also benefit from knowing how to roll options, which I recently just made a video on that's not required, but I do recommend you check it out so you can run the wheel strategy even better. Before I jump in and flood your pockets with money, make sure you smash that like button for Uncle Henry and subscribe to the dopest YouTube channel out there about option trading. So this strategy is truly going to change the way you think about generating income through option trading. Best of all, you can enter a stock and reduce your cost basis down to eventually $0 for a stock. Here's the steps to running a successful wheel strategy before I show you a visual example. Number one, pick a stock. Ideally, you like this stock because it will make running the wheel strategy so much better, because when you eventually get put the stock, you will not mind owning it anyways. Number two, sell a cash covered put. We write a contract that someone else buys. When they buy the contract, we agree to buy 100 shares of stock that we choose in the case that the stock actually falls under a strike price that we determine ourselves. So we have so much control with this strategy. In return, the buyer of the contract pays us a premium, which is just money in return for the contract. It is up to you to find that boundary, but generally, if you want an option to be worth your time, your premium should be at least 1% of the stock's price. Now you just repeat this every week until you get assigned. Step number three is where the wheel becomes the wheel. Once assigned, you sell a call option. We write a contract that someone else buys. When they buy the contract, we agree to sell 100 shares of the stock that we own in the case that the stock goes above a strike price that we determine. In return, the buyer of the contract pays us a premium, which is just the money in return for the contract. I'm going to give you a very good visual explanation so you can understand this better, but I bet now you can see why it's so powerful and easy to run the wheel strategy and make a lot of profits. You can keep pocketing the premium every time one of your contracts expires worthless and build this up into a large portfolio. Let me share my screen with you guys and give you some real numbers and examples. All right, guys, so we're gonna jump into my screen. I'm gonna show you some real receipts. Not too many YouTubers show you real receipts, real results, but I'm super transparent here on this channel because my goal is to help you guys as much as possible. So I'm putting it all out there, putting my portfolio on the line. I'm gonna explain exactly how I take advantage of making weekly income basically by selling the wheel strategy, or essentially I call it selling the wheel strategy because when you run the wheel strategy, you're selling puts to get into a stock. Once you get a favorable price on a stock and you do eventually get into it, and by the way, guys, the goal is just to continue collecting that income from selling put options. But once you do get in, then you go ahead and you start selling call options for that income. So you sell puts to get in, you sell calls to get out, and on the whole process, during that whole time, you're generating consistent income, you're collecting income from both sides of the equation. You're collecting income from the put side of things, and then once you get into the stock, you're selling calls and you're collecting income from the calls. So guys, check it out. This is a strategy that I run all of the time. So here I've sold a put on NEO. I made $100. That was just this week, okay guys? So that's going to expire today. And honestly, since I didn't get put the stock, what I'm going to do is on Monday, I'm just gonna sell more puts again and continue that strategy until I get put the stock. And this is actually a strategy that I've been using for a very, very long time on Tesla. So if you guys check it out, Tesla is a phenomenal stock to do this on, because as you guys can see, by the way, I opened up this position today. So this is one of the losing trades that I have that's currently down $106, but that's because I opened it up today. I do expect this position to be profitable at expiration. If you guys check it out, I'm selling, these calls over here because I have shares of Tesla and it's $1,000, $1,100, okay? And I'm consistently selling puts because when you sell puts, right, on the wheel strategy, essentially what you're doing is you're collecting premium. And in the worst case scenario, guys, I'm going to give you the scenarios that are going to happen. Scenario A, the stock does not fall to your put strike price. And if it does not fall to your put strike price, phenomenal, right? You've collected that income, you've collected the premium, and it was in your pocket to begin with, but now you no longer have an obligation. So after the option expires, you go ahead, you open up a similar option, and again, you go ahead and collect that income. Now, scenario B, if the stock falls to, let's say, your strike price, right? So let's say that, I just did this trade on Oatly. I just posted this in my private group. If Oatly goes down to, let's say, $17 per share, well, I'm getting a good price on Oatly because I'm going to be forced to buy it at $17.50. And if you take a look at Oatly's current price, okay, I'm going to open up Oatly real quick. Oatly is currently traded at $18.96. And as you guys can see, this stock was trading at $25. I think it was at $26, right? If you look at the total history here, it peaked around $28.73 on July 11th. Now it's trending down, right? So I really like this stock because it became a whole lot cheaper. And as you guys can see, the market cap, well, it's not posted on Robinhood here. Oh, yes, it is. It's $12 billion. So by selling a put option, I want to buy the stock at $17.50. So essentially, when you run the wheel strategy, you're just starting off by, essentially selling put options. So I'm selling a put option at 17.5 because I would love to own Oatly at 17.5. And in scenario B, like I'm explaining here, is if Oatly goes to $17, yeah, you'll be down just a little bit on the put option, but you're going to be owning Oatly for an average price of $17.50, when currently it's $18.93. So you'll literally be buying the stock at a lower price than it's ever traded at. And if you get in, fantastic. And again, if you don't, you still get income. Either way, you've collected the income from selling that put option. So in scenario A, fantastic, you get to collect income. And in scenario B, you get a better price than any investor has gotten on Oatly in history. Oatly has not been at $17.50. So you're going to get a very attractive price on Oatly. And then in scenario B, where the wheel really comes into play, aside from just selling puts, is once you do get put Oatly shares, if it's at $17.50, what you're going to end up doing is going ahead and selling a call option for, say, the 20 strike price. So now your average price on Oatly is $17.50 per share, but when you sell a call option, now two things happen, right? You're collecting money on the call option, which is fantastic. Again, you're collecting that weekly income, right? You're collecting that consistent cash flow. And if Oatly were to go to $20, fine, you're going to be selling Oatly at $20 and your average price per share is $17.50. So now you're making a whole bunch of money on the stock appreciation itself, and you've made money selling the put to begin with and selling the call. So you're making money on all sides of the equation, on the put sides of the equation, on the call side of the equation, and now the stock is appreciating for you as well if you get put the stock. So essentially, in both case scenarios, you're in a very strong position because either you're just collecting that income consistently, or you're actually getting into the stock at a very good entry price and you're picking your exit price, which is higher than your entry price, okay? So that's an example on Oatly. And as you guys can see here, I'm running the same strategy on Palantir. So with Palantir, I sold a 21.5 put. I posted that in my Discord as well. And here we're down just a little bit, okay, guys? And this is actually interesting because unlike Oatly, which is out of the money, I think Palantir is right at the money, okay? And I've only got about an hour and a half more of trading today. And as you guys can see, this option expires today at $21.50 and the stock is currently at $21.36. So what's going to end up happening is I'm literally going to run the wheel strategy here. And what's interesting is, just to show you guys how this actually played out, if I scroll down to how much money I collected on Palantir, let's just see what my break-even price is. Because one of the things with the wheel strategy is, even if you get put the stock, you still want to calculate what your average cost is. Because even if you're selling, let's say, Palantir in this case scenario, right, at $21.50, well, we want to factor in how much money I collected for selling the put to begin with. That way, when my average price, when I get put the share says $21.50, it's not exactly $21.50 because I've collected premium from selling the put option. So let's take a look and calculate what that is. So if you guys take a look here, I've sold a 21.5 put option just a couple days ago here, and I've collected $11 per share. So what that means is when I finally get put Palantir stock at $21.50, it's not really $21.50. You need to factor in this $11 per share. So if I take $21.50 and minus $11, or really 0.11 as it says here, it's going to be $21.39. So Robinhood and every single brokerage account will say that your average price is $21.50, but in fact what you guys should be doing is having an Excel sheet on the side, or you can write it down on a piece of paper, but your actual average cost is going to be $21.39, and that's going to give you more information on, once you do get put, what your next steps are. What call option do you want to sell next, and essentially how do you want to run the wheel strategy. So for me, right, I've collected $11, or essentially 11 cents per contract. So my average price is going to be $21.39. Now, if I go to trade Palantir options, because essentially I'm expecting to get put shares of Palantir stock today. So I'm going to get put the shares today at about 4 p.m. So on Monday, I'm going to have shares of stock. And the first thing I'm going to want to do is sell call options right off the gate, 9:30 a.m. Eastern, right off the gate. Maybe 9:35, 9:40, I'm going to give 5 or 10 minutes to see what's going on with the stock. But essentially right away, I want to collect premium off of holding this position. So what you're going to do here, and what this means for you guys, is you're going to go to sell Palantir call options. Obviously, you're not going to go for July 16th because that's today's close. You're going to go for that week, which is July 23rd. So on Monday, you're going to open up that Friday's call options. That's just the way I like to do things. You can go for monthly income if you want to. I love that weekly income because it's just more fun. It's consistent. It's just the way to go for me. I love it because it's kind of like getting paid every single week, and it feels better to get paid weekly than it feels to get paid monthly, because then you have more cash in your account. You take that money, do whatever you want with it. Either go spend it or continue growing your account using the option strategies that I teach on this channel. So since our break even is actually $21.39, you can actually sell at the money call options at the 21.5 strike price. I'm going to give you guys two different options that you can do. So you can just sell 21.5. You can collect about $49. It's obviously going to change just a little bit on Monday, but let's just say it's about $50, right? Let's say Palantir moves up just a little bit or whatever. We're just going to say it's about $50. So now $50 divided by $2,100 worth of stock that you're holding is over a 2% return, guys, because 1% of 21 is going to be 21 cents, right? And 2 times 21 cents is 42 cents or $42. And this is $49. So it's over 2% a week, guys. Tell me, where else is someone going to teach you how to make about 2% a week on your capital? I mean, if you look at the stock market, it's about 8% a year, 9% or 10% a year. Here, if you're collecting 2% on this wheel strategy, right, on selling this covered call, if and when I do get put the shares here, 2% a week, that's 8% a month, and that's over 100% a year returns, guys. So you can double your money using option strategies like this, okay? This is one of the most fantastic things about options because you have so much control with trading, and with the wheel strategy, I really love it because you have control as when you get into a stock, when you sell a put option, you pick the strike price, right? So you know exactly what price you want to enter a stock, and once you get put that stock, like in this case scenario with Palantir, then you get to pick your exit price. You get to pick exactly at what price you want to exit at. And that's where I want to tell you guys about, how I would look at picking a strike price. So I've mentioned that, selling the at the money call option at $21.50 is good, right? Because your average cost is lower than $21.50 and you get to collect 2% premium. However, I'm going to show you guys an even more interesting option that you can execute and take advantage of. So rather than selling an at the money call option, you can actually go a little bit out of the money, and this will give you a key advantage. And this advantage really is that you're still going to collect premium, right? You're going to collect a little bit less premium because, as you guys can see, the farther out of the money I go, obviously the less likely that option is to hit the strike price. Option traders know this, and for that reason, the option price and the option premium is lower. So the higher I go, the lower the premium. However, the higher I go, the more appreciation you have in terms of the stock itself. So when you sell a call option here at the money, yeah, you're going to collect 2% premium, but you're capping yourself at $21.50, which again is fine because you're going to make some money in terms of capital appreciation, just a little minor amount, right? The $11 because your average price is $21.39. But you're just mainly going after the premium. However, if you go for something like the 22.5, now you're going to make about 1% rather than 2%, right? You're going to collect $19 worth of premium, which is still good. About 1% a week is 4% a month, which is about 48% a year. Still fantastic, fantastic high returns, right? You're obviously going to build your wealth very quickly if you're selling options at 1% a week. However, here, the interesting thing is you're giving yourself some room for capital appreciation. If you are a little bit more bullish on Palantir and you want to put in a little bit more risk and you're going to say that, hey, I'm going to sell the 22.5, you're giving yourself about $100 worth of capital appreciation. Now, if at the end of the week on July 23rd on Friday, Palantir ends up being at whatever, something around 22.50, right? Or 23 or 24 or 25, doesn't matter. If it hits 22.50, you will be forced to sell Palantir stock at 22.50. But here's the good news. Not only have you collected the premium, first of all, from selling the put, second of all, from selling the call option, you made 1%, but now you have made $100 fully on the stock appreciating itself. So if you own Palantir at 21, let's say 21.50 roughly, right? And you sell it at 22.50, that's $100, and $100 divided by 2,000 is essentially a 4% return, which, guys, 4% in 1 week, that is phenomenal because you're not only making 4% on capital appreciation, don't forget you've also collected 1% of the premium. So that's a 5% return in just 1 week. I mean, that's how you really aggressively build your wealth. That's how you run the wheel strategy. And I do want to show you guys how I'm running the wheel strategy on Tesla, but essentially in a nutshell, I pretty much explained it to you guys. You want to sell puts to get in, sell calls to get out, and you essentially want to do that whether it's at the money. If you want to collect more premium, you do it at the money. Now, if you're after less premium and you want to make a little bit more capital appreciation, then you're going to go a little bit more out of the money, giving yourself opportunity to have capital appreciation on the stock rising itself. So this is a strategy that I love using on a Tesla because, you know, what you guys have to understand is running the wheel is more profitable on stocks that have higher implied volatility. Why? Because higher implied volatility means that the option is going to be more expensive. So when you go ahead and sell an option, especially selling options, because options become more expensive with higher implied volatility, right? More higher volatility, more premium. And when you're selling options, more premium is on your side. You want to be collecting more premium. So what I like about Tesla is Tesla has more implied volatility than the average stock. Obviously, my portfolio is mainly Tesla here on Robinhood. I have other portfolios. I have other platforms where I trade on. But essentially here, since I have a giant position in Tesla, I love using implied volatility to my advantage. So I do two things. I sell puts because I always want more Tesla at a lower price, and I'm always selling call options. So as you guys can see, next Friday on July 23rd, I have sold Tesla 780 calls, and I have sold Tesla 760 calls, and both of them have already made money. And at the same time, I'm also selling Tesla 575 puts because I want to buy Tesla at 575. That would be a fantastic price to enter into Tesla. So I'm doing two things. I'm owning Tesla stock, but that doesn't mean I can't run the wheel strategy on both sides anyways. So I'm selling puts. If I get executed, I'm ready to sell some calls on the additional shares of Tesla that I own. However, if I don't get put, phenomenal as well, because I'm just collecting premium on the puts. And while I have the stock, I'm also selling calls. So always generating income, guys. I'm all about income trading because income gives you more freedom in your lifestyle. It gives you more security on what type of money you can spend. And making income is just my way of having more security. Sure, you can just own stocks. You can just be a stock trader. But most of the time, what I realize is with stock traders, you really can't predict much. Nobody can really predict what a stock is going to do in the future, right? You can cross your fingers and hope that the stock is going to go up 10, 15% a year. Maybe if you have a more aggressive stock, sure, it might go up like 30 or 40% a year, but you also have a more significant risk of it pulling back, right? But with options, you have direct control over exactly how much risk you're taking, over exactly when you want to enter a stock, and exactly how much reward you're getting. So you can calculate exactly what your income is going to be per week. In my case scenario, what I teach students, but if you also want to go for that monthly income, you want to put in less work and you only want to trade just a couple hours a week or even less, you can also do that by just selling more longer dated call options or selling more longer dated put options. You don't have to do a weekly income strategy like I do with the wheel strategy. You can go for a monthly wheel strategy, or you can even do leaps. So essentially the wheel is one of my favorite strategies because it gives you an automated systemic way of making consistent cash flow. If you want very hands-on access with me, as well as my team of 6- and 7-figure coaches, the best way is by watching the free video training that I have below. You can click the application, you will learn about my brand new Option Income Academy, and how my team and I are making successful option trading students every single day through my live option plays and teachings where my students mimic my daily trades in real time. I'd love you to check out the training and have a free call with my team. Thank you for watching, and check out my option playlist on the screen right now.